we've lived through this before. When you look back to what went on with, when Flash Boys came out and some of the things around order routing and payment for order flow and that whole routine. So I think using that for an understanding of the overall structure of the markets and what went on here, right? What actually happened when NSEC, DTC got that notification in terms of, the settlement risk that was there? What happened in that? Were so many people caught short? Where was the risk management? Where were there, order rooms and risk management systems? How did that all work together? Because I think if we can get an understanding of that and how the sort of shorts in the background, how the whole, the market making situation behind it, how all those market centers acted, if you can get an understanding of the whole situation, maybe you can start to address some of the risk that this actually posed to the little guy, right? To the retail investor who really is going to end up suffering on the back end of this.
Carl,
so I think if we can get good information out of it, that would be my goal.
Yeah, certainly I think all eyes will be glued on that situation. I'm curious what you think of the fact that investors put another $3.4 billion into Robinhood in recent days. That's more than I think the company had raised since its inception up until this point. Is this investors looking to protect their previous investments? Is this a vote of confidence, given the fact that Robinhood has been so downloaded and has really now become a household name for better or worse? Or does it speak to the value of its business, of those order flows, given the fact that they are so heavily skewed towards retail investors and younger retail investors?
So to unpack that, just a little bit, what I would say is they have an amazing system that provides a very easy to use user interface, right? UI, UX that I believe is, really, really well done. And, the retail investor has really adopted to it and continues to open new accounts and download. If you just look at some of the, data available on the downloading of the Robinhood app, I think people are still extremely interested in the platform. They've made it extremely simple for the retail investor to, get into the marketplace. So I think there's a lot of value here. The other points are they needed that, capital or the infusion of that equity to continue to operate, build their business, and address some of the issues as a result of this. So, the decision is kind of easy if you're already in that investment and you see how good the technology is and where they think they can get to, right? You're going to want to shore it up and keep it going. And, you want to protect the company and protect the investor base.
Carl, it's David, and it's good to see you. On this Robinhood question, though, as somebody who has somewhat unique perspective here, I mean, it appears that a lot of their money is made by just selling their order flow, maybe to the likes of Citadel and some others. I understand the power of the platform, but it does also seem to be a more capital-intensive business than perhaps they had anticipated. I'm just trying to understand what the real business is there. You seem to obviously view it positively.
Well, I view, let's just step back for a second, because what I view is leveling the playing field for retail investors as extremely positive, right? It was the premise that started E-Trade way back when in 1992, right? So we've been at this for a long time trying to level the playing field and give the retail investor access. So that's where I would sort of, full stop on that point. In terms of payment for order flow or, the market centers behind this, that's not really where, from what I can tell and what's available out in the public market and what they've disclosed so far, that's not where the capital need or the liquidity crunch came from. It really came from, the clearing center, the central clearinghouse at DTC, saying that there was settlement risk that was involved that was a greater extent than they'd ever seen before because of the volume and enhanced, unbelievable volatility that was taking place. And when they saw the numbers come through from, the trade reporting facility in terms of what was actually out there was a demand for additional liquidity, right? You have to, by the time those trades actually get into DTC, right, they're already cleared on the back end. They're already matched by the market centers, right? Payment for order flow is a completely different issue. Yep. Go ahead, David. Sorry.
Yeah, no, I get that. I get that. I guess I'm just trying to figure out exactly what Robinhood's business model really is in terms of their ability to actually profit. Because you could argue, Carl, that if they were a public company and we watched this occurring in real time with their stock price reflecting the difficulties they were having, it's very much unclear to me whether they'd still even be around.
Well, the one thing I would say is from time to time, right, and it's one of the reasons that I'm very careful about speaking in any negative tone about any competitors or other systems out there on the street. From time to time, all of the, brokerages and the retail houses will have their issues, right? Whether it's a technology outage, or some kind of a slowdown or an order routing problem. So we all go through those hiccups. And for something like this, right, with the unprecedented volumes that were out there and just the sheer volatility and magnitude, what I hope they'll do, David, is look at this from a risk management perspective, sit down with their order room, sit down with their risk management group, do a full diagnostic, right? Learn from it and build to address it. And it appears that that's what they're doing, because some of the information that's coming out, I think, into the marketplace today is a lot more clear. At least they're trying to, sort of get out and communicate a little better with the street.
Shepard Smith here. Thanks for watching CNBC on YouTube.